Good evening to you all. It's good to see so many people. And thank you, AJ Bell. May I say that at Henderson Far East, we've seen a great deal of growth in retail shareholders in our shareholder base. And it's difficult to actually get access to retail shareholders. I mean, obviously, we can see wealth managers all over the place. But to see retail investors here and get a chance to speak to them and get their feedback is something we're quite grateful for. So we've heard about growth in Asia. We've heard about the UK. I want to give you a story which is the other side of Asia and the alternative to the UK. So I'm going to tell you that Asia is not all about growth in earnings. It is also about growth in dividends. And I think for a lot of investors these days, with interests the way they are, high levels of yield and the potential to grow that yield is really, really important. And Asia gives you that opportunity, I think, that nowhere else in the rest of the world does. So we are talking about growth, but it's growth in dividends and how that underlying growth will make its way to you as income over time. But I will start with a little bit of why Asia. Because obviously for income investors who maybe own a lot of UK stocks, know these names, will think maybe that getting income from outside of the UK is a risky proposition. And I can't argue with the fact that it probably is. It is a more volatile area. But there are things that are going on there for an income investor which I think make the story much more sustainable over time. And obviously we get that growth from the underlying structural growth story from Asia, which Ewan's already mentioned. So why? Well, I'll talk about the positives. The headwinds you probably all know about, because they're not just Asian headwinds, they're global headwinds. But valuations, we're cheap. There's lots of equity markets around the world at the moment which are not cheap. The US is virtually at all-time highs. Asia's nowhere near all-time highs. So valuation is on our side on a relative basis. There are things that are going on in Asia whereby there are reforms taking place in countries which are beneficial not only to the economic growth of those countries, but also to us as shareholders. So these companies, the governance is improving. The awareness of dividends and what shareholders want is also improving, and that can benefit us. And there is a degree of resilience. When you look at the UK, the US, and parts of Europe, whether we go into recession or not is probably a flip of a coin in a lot of these places. And there's not much flexibility. Fiscal deficits are high, etc. Levels of debt are very high as well. Where in Asia, we still have the potential to cut interest rates. We had Indonesia cut interest rates yesterday. We still have a level of flexibility with monetary and fiscal policies which give us a chance to alleviate some of the problems that could happen in the rest of the world. That flexibility does not sit, on the whole, with the Western world. And dividend growth. Ewan's just said to you that earnings growth is the best story in Asia. I would argue that dividend growth is the best story in Asia. And I'll tell you why in a second. The headwinds, political uncertainty. I'm glad we were showing a chart earlier of Trump and Xi, because I don't really want to talk about trade wars. You can ask me about that afterwards if you want. But I'm not going to talk about that. But clearly, political uncertainty, protectionism, and slower growth all come out of this. It's very difficult to judge which way it's going to go. But what I will say is if we think that the trade war between the US and China is the be-all and end-all, once it's settled, that's the end of the problems between the US and China, then we're all mistaken. This is going to be going on for 20, 30 years, probably outlive most of us. The transition from one economy being the largest economy in the world to another, there's history of how much disruption is caused globally. And we've just got to hope that this is managed in a measured way. Because the consequences if it doesn't are pretty severe. Now, I'm sure someone's going to ask me about that afterwards, but if we want to have a talk afterwards about that, then that's fine. But clearly that is a big headwind. So, negative momentum, earnings. Earnings growth in the region with these charts on the right-hand side just show you what analysts' expectations have been. So if I'd been here a year and a half ago, it would have been the best earnings story we'd have had for a number of years. Now, clearly it's not. Global growth has slowed, there's pressures on margins, there's disruption, etc. So on the whole, earnings are not looking as good as they were, definitely. There are pockets of growth, and there will remain pockets of growth. So when you're investing in the Asia-Pacific region, you have to be very selective about which areas you're focusing on. Valuations, as I said, we look cheap. Return on equity, which Ewan alluded to earlier, is pretty, as a measure of profitability, was recovering nicely, not so much anymore. But again, these are averages. You have to be very specific. But valuations compared to the rest of the world, which is the PE for Asia, relative to the rest of the world, is still below where we have been in the longer term. Off a slight recovery, has to be said, but we're cheap. The markets are cheap. And the reforms. I alluded to some earlier, but the reforms in terms of taxation, in terms of governance, we're seeing quite a lot, whether we like what's going on in China, but the state and enterprise reform is a major factor for investment globally, not just in the Asia-Pacific region. We're seeing change in India, although I can talk about later, I don't quite believe in the changes there, as maybe some others do. Big changes in Korea, even Japan, not really our remit, but there are big changes going on there in terms of governance as well. So let's talk a little bit about China, because every time I read the papers in China, about China from the UK, whether it's the FT or listen to the BBC News, I kind of roll my eyes a bit, I have to say. The headline of "This is the worst growth in 17 years," which came out the other day, I mean, it's absolute rubbish, isn't it? I mean, if you have an economy that's growing at 10, 15%, it can't keep growing at 10, 15%. It's the law of big numbers. The bigger the base becomes, the lower the growth has to be. It has to happen. So comparing growth in China and saying this is the worst it's ever been is a really ridiculous argument. There is growth in China. You just need to look for it. It's not in manufacturing and industrials. State and enterprise reform and lack of demand, both globally and internally, and oversupply and overinvestment in the recent years, has meant the manufacturing sector has generally been very poor. And that's borne out by the industrial numbers over there, and the industrial profits on the left-hand side, and the manufacturing purchasing managers indices. But you look at house prices on the left. House prices are still growing quite nicely. And services PMIs are still also growing very positively. This is a two-speed economy. The stuff that's being impacted by global growth and slowing domestic demand in the industrial and manufacturing sector is weak, but the consumer is still motoring on. It's still one of the best consumer stories in the world. But if you read the FT or listen to the BBC News, you'd never get that. The thing that is important, and this kind of alludes more to a growth story than it does to an income story, is the change. The amount of money China is spending on new products and new technologies. And this isn't just R&D on manufacturing processes, which, as I say, are slow and probably aren't coming back. This is R&D in areas like healthcare, in new energy vehicles, in education, these kind of areas, fintech. So actually, R&D, Chinese companies are spending more on research and development than the EU and the US. And in 5 years, they will be spending more on the R&D than the EU and the US put together. They're spending a lot of money. So the leading technologies we're maybe hopeful for in the future, I would hazard a guess that China will be at the forefront of most of them, whether we like it or not. And as I say, it is innovation, because the number of patents being filed are also incredibly high. This is not new money after old. This is new money in new areas. So the question we have to ask ourselves is, if we're global investors, is which global companies that we own in our portfolios are going to be disrupted? Because these companies all the way around the outside are have been dominant in their fields. The companies in the middle are Asian companies which have the significant potential to disrupt. I think initially it starts within Asia and especially within China. Companies, local brands taking market share from global brands, but ultimately, within 5 years, we will be buying Chinese branded products in supermarkets, even in car forecourts. There you go. There's a proposition for you. Because 10 years ago, would you have bought a Samsung TV? No, it's cheap foreign rubbish, wasn't it? Would you have bought a Hyundai or Kia 10, 15 years ago? No, you wouldn't. In 10 or 15 years, in 10 years' time, you will be buying Chinese branded products. And you will think of them as high quality products, not necessarily cheap foreign rubbish. That's the natural progression. We happened with Japan back in the 70s and 80s, happened with Korea in the 90s and beyond. China is the next driver of your regular branded product. So our job as investors, both you and myself and all of us here, is to find these companies which will be the global leaders. Some of them are already here. I mean, Huawei you're probably well aware of. The reason why Huawei is being focused on is because it's already a global leader. It has over 50% of telecom infrastructure globally, so why is the US focusing on that company? Because it's already a leader. These other companies will be leaders. We may see some more reaction from the US in the years to come because of that. So, that's the little bit about Asia and the growth bit. Now let me talk to you about the income bit, because to me that's more exciting. And I'm an income manager. Clearly nothing about income managers is exciting, but I care about cash flow. I care about profitability, and I care about how that comes back to us as shareholders, and ultimately how it comes back to you in dividends. Dividends are really important for total return. It's happened to every market over hundreds of years. And if you look at total return broken down between price and dividends, it's pretty much 50-50 in a lot of areas. So to ignore dividends as part of total return, you're potentially ignoring 50% of your return. Now, Asia, most of the performance so far has been price. But as these companies mature, cash flow generation improves, more and more of that will come back to us as shareholders. So, why will it come back? Well, these four charts, which hopefully you can see, they're a little small, but this is just like a health check of corporate balance sheets. So what we have here is very low levels of debt, investment that used to be sky high as they built kind of ego projects in office buildings and this, that, and the other, that's all gone. So capital expenditure is constrained, and as a result, cash flow is going through the roof. And let's face it, as dividend investors, cash flow is what pays dividends, not earnings, cash. We have a lot of cash sitting in Asia. Give you some idea, this is the multiple of dividends paid sitting in cash. So forget the scale on the right because that's just Japan, but on the left-hand side, basically Asia is paying out has cash 9 times its level of current dividend. You look at the US and Europe, we're looking at less than 5 times. So that, if you're looking forward and you want this dividend stream on an ongoing basis, if your dividend stream is backed by cash, then you have to be much more confident that that is going to be sustained over time. Dividend growth. If you put up earnings growth and put dividend growth next to it, dividend growth exceeds earnings growth over this period. Caveat, dividend growth is coming off a very low base. You'd expect it to grow. The question is whether we still get these levels of dividend growth going forward. And I would argue that we do. We're backed by cash, the potential for dividends to rise, payout ratios, i.e. the percentage of profits paid out as dividends, is only 35%. The UK is, in a lot of cases, almost double that. So you've got this potential for dividend growth almost irrespective of earnings growth. That's why I'm so positive that dividend growth is a more sustainable growth story than earnings in Asia. It's less exposed to a cycle. And this is sustainability. Well, everyone says, Asia's all about share price and not about dividends. Well, actually, dividends have been much more sustainable than you probably think. On the 10-year average of this, 53% of companies have raised their dividends, and only 23% have cut them. And it's not as cyclical as you would have thought. Dividends are more entrenched than a lot of people think. I've just seen 6 minutes come up, and I know how many slides I've got left. So I won't talk about that one. Dividend surprise. Ewan talked about earnings surprise, companies which will surprise the market positively and the share price reacts. I'm going to give you another take on that, which is dividend surprise. And I would actually argue in this environment of low interest rates where everybody's looking for yield, a dividend surprise is more powerful than an earnings surprise. Because everyone wants yield, everyone wants higher dividends. So we look for companies which will surprise us with dividends. And this is the reaction. So basically 2 weeks after a positive dividend announcement is the blue line. And negative, the red line. So positive surprises in dividends is positive for capital performance. So I'm not talking to you all here about income. I'm talking about what income does for capital and total return. So with 4 minutes left, 5 minutes left, a little bit about Henderson Far East Income. I've managed this since 2007. We have a dividend yield currently of 6.2%, which is high, very high relative to virtually anything else in the closed-ended sector. We generate that with a portfolio which yields around 5%, and we very selectively use options to generate some additional revenue to get that up to 6%. What the options give us is the flexibility to buy dividend growth, and this is really important because dividend growth will drive your capital performance. So we want the flexibility to buy companies with lower yields which will grow their yields without impacting the amount of dividends we can pay you now. It's very conservative, it's very selective, but it gives us that flexibility. We have a dividend reserve which is 2/3 of a year, so you should be pretty confident that whatever happens, that level of dividend should be sustainable. And from a capital share price performance, we've actually outperformed the index this year by 5 percentage points. Despite the index rising by 10%, we're up by 15%. So income can be good for capital and can be good for total return. Now I'm going to be a little bit rude about the UK, sorry, because diversity of income is important. And I know earnings, and Matt said earlier about earnings coming from overseas, etc. But in dividends, the UK is massively concentrated. 40% of UK dividends come from 5 stocks. So, as you had a cut in Vodafone not so long ago, Vodafone was one of the big dividend payers in the UK market. It's not anymore. That can have a significant impact on your income if that bigger dividend payer stops paying or starts cutting its dividend. In Asia, for example, 25% of total dividends come from 10 stocks and 7% from 20. So, it's a much more diverse mix. You're also talking about 11 or 12 different countries, lots of different currencies. So the chances of you being short from an income perspective because one of those companies you own doesn't pay a dividend the way you want, you've got less chance here than you would in a market which is more concentrated. We've grown our dividend by 6% compound since 2007, which compares roughly with 2% in the FTSE. Again, sorry. So again, this is a much more superior dividend growth model than a UK equivalent and the rest of the world for that matter. We've been quite fortunate to have traded a premium now for, the last 10 years, pretty much, since 2009. And we've been issuing shares mostly to retail and to platforms. So, 5 of the top 10 holders are platforms. Hargreaves is our biggest shareholder. And a lot of the shares we've been issuing have been to retail investors. I suspect when they see 6.2% dividend yield, that probably helps. But that's kept us at a premium. The premium varies between probably about 3 and 5% over the last 10 years. Performance-wise, I mentioned year to date, we're up 15% in sterling terms. Now, clearly, it does help that sterling's been weak. So thank you, Boris. So that has obviously helped our returns. The index is up 10, but 5% ahead of a rising index for an income fund yielding 6% is unusual, I have to say, but we welcome it, and long may it continue. But we do this with a volatility which is less than the index, as you'd expect from an income fund. We build the portfolio kind of halfway between dividend yield on one side and dividend growth on the other, supplemented, as I say, by option premium, which is usually around about 10% of our revenue. Where we're exposed, we like China, but we like domestic China. The themes that run through our portfolio, I'm not going to go through this in too much detail, mainly because this is shouting at me. But the themes that run through our portfolio, and I agree with with you in here is that we need domestic demand stories as incomes rise in Asia. These are the stories of the future. Ultimately, these companies may go out in the world and take market share from global companies, but at this point in time, we want global, local companies with local brands which will take market share from foreign brands. So we own things like Kweichai Moutai, we own Anta Sports. These are companies which are taking market share or growing rapidly or taking market share from leaders. And these are the kind of companies we want to own. The domestic story, rising incomes in Asia, these are the stories we want to own. So at that point, as that now is really, really shouting at me, I will leave it there. Thank you for your attention, and I'm sure we can have a chat afterwards if need be. Thank you.